Welcome back to part B of our topic 1 lecture. This time, we will be covering the rest of the topic in chapter 2 of your textbook, and we will be focusing on learning objectives 6 and 7. All right, so learning objective 6 is understanding the concepts related to the financial reporting requirements in GASB. GASB has introduced this integrated accounting and financial reporting model that is embodied in the conceptual framework for financial reporting. Currently, as shown in chapter 2 of your textbook, there are 6 concept statements provided. Concept statement number 1 is the one that stipulates the objectives of financial reporting. And as you can see here, the first objective is to provide information that can be used to assess a government's accountability. The second is to assist users in making informed economic, social, and political decisions. So these are the 2 objectives of financial reporting. Now, in assisting users to make informed economic, social, political decisions, we need to identify who are the primary users of governmental bodies, particularly when we're talking about local as well as state governments. So the primary users are those external to government, and they are principally the citizenry, the citizens, the legislative and oversight bodies, as well as the creditors. So these are the 3 main external uses of governmental bodies. And it's important that the financial reports provided aids in helping the users make the informed judgment and decision. And to do that, the information must be useful. So the usefulness of this information is shown when the characteristics of understandability, reliability, relevance, being timely information, being consistent and comparable are actually present. So these are the main qualitative characteristics you will recall are the same characteristics of the financial reporting standards as shown in FASB, Financial Accounting Standards Board. Communicating the information in a manner that is helpful to the user is a very important part of making useful information. GASB concept statement number 3 identified 4 main areas. Number 1 is the recognition, number 2, disclosures, and the last 2 has to do with presentation. So when we are recognizing the item, it means we need to record it in the financial statements. Disclosure includes the recognized financial statement items and also the notes to the financial statements. When we're presenting additional information, we can either present it as part of RSI, so the required supplementary information, or as part of other supplementary information, OSI. So let's look at the recognition and disclosure first. When do we recognize an item? So it says here that an item of information that meets first the definition of an element and second is measurable with sufficient reliability should be recognized in the financial statements. So in order for us to understand what meets the definition of an element, we need to know what are the 7 elements as prescribed in GASB. So the 7 elements are these, and you will find that many of these are quite familiar, similar to the elements in financial accounting. So the first one is assets. I'm sure we are familiar with this. So assets are the resources with present service capacity that the government presently controls. Remember, it is control that is the determining factor whether an asset is recognized as an item, an element, all right? So it's not ownership, but control. Number 2, deferred outflows of resources. So these are pertaining to consumption of net assets by the government that applies to future reporting period. That's why it's deferred, because it's having to do with future reporting period. So when we're talking about consumption of net assets, remember net assets is simply what? The difference between assets and liabilities, right? Number 3, liabilities. These are your present obligations to sacrifice resources that the government has little or no discretion to avoid. So similar to the liabilities in financial accounting. Number 4, the fourth element are deferred inflows of resources. So it's kind of the opposite of item number 2, deferred outflows. This is deferred inflows of resources. So these are acquisition of net assets by the government that applies to future reporting period. So that's why it's deferred, because it's pertaining to future periods. Number 5 is the net position. So what is net position? It's simply the residual value, or what's left when you add your assets plus deferred outflows minus liabilities and deferred inflows. All right. So this actually is the net position that appears in the statement of financial position, otherwise known as balance sheet. Number 6, the inflow of resources. So this is very similar to your revenues and other sources or resources. This is the acquisition of net assets by the government in the current accounting period or the reporting period. And finally, the outflow of resources is similar to your expenses and expenditures and other uses of resources. So this has to do with the consumption, the usage of net assets by the government, again, in the current reporting period. So when any of the items of information meets the definition of any of the 7 elements, and so that's the first requirement, it meets the definition of an element and it's measurable with sufficient reliability, then an item has to be recognized. We will touch on measurability later on. So let's look at the second statement. What about notes? Well, a note should be used if it can help support an item that has been recognized in a financial statement or provide information that is essential to the user's understanding of the item. Now, there are 2 types of notes. We've already mentioned the RSI, the required supplementary information. So RSIs are used to provide information that is essential. It's essential because if we don't provide RSI, this information, the financial statements and the related notes cannot be placed in the proper context. So it can be misleading if we don't provide RSIs. So examples of RSIs would be, first and foremost, the management decision and analysis, MD&A. Other RSIs might include the budget to actual schedule, so the comparison of budget and actual, and several pension disclosures might also be an RSI. What about other supplementary information, OSIs? These are information that are provided that's useful but not essential in order to understand the financial statements and related notes. So much of the other supplementary information is found in the statistical section of your CAFR. So examples of these would be the charts, the graphs pertaining to demographic information, and things of that sort. So information that an interested user of the financial report would consider useful, but it's not essential for them to understand the correct context of the report. Now let's go back to the second requirement as to when can we recognize an item. So the first requirement is it must meet the definition of the element, and the second is it must be measurable with sufficient reliability. So the question you might ask is, what's the measurement attribute? All right. GASB identifies 4 measurement attributes that can be used in order to determine the initial or remeasurement of amounts for assets as well as liabilities. So these 4, I'm sure you would be familiar with, is the historical cost, the fair value, replacement cost, and settlement amount. So I'm sure you know that historical cost is simply the original cost paid for the assets. For example, fair value could be the market value now. Replacement cost, as the name suggests, is the cost of replacing the same asset as of now. And the settlement amount would be the amount that you use to settle the asset or the liability. Now let's go deeper into the financial reporting model. We recall that the basic financial statements have 2 sides to it, the government-wide financial statement and the fund's financial statement. And we will be looking at this more deeply in the next few slides. So government-wide financial statements is measurement focus on the economic resources of the governmental body. Remember that the basis of accounting use is accrual basis, and the accountability that we're focusing on is on the operational activities of the government body. The financial statements provided or prepared for government-wide financial statements include the statement of net position, which is comparable or similar to the balance sheet that are prepared in financial accounting. And also the second one is the statement of activities. This will be reporting on the expenses, revenues classified by program or function, and it will be using separate columns for governmental activities, for business type activities, and other component units like, for example, fiduciary activities and the like. The fund financial statement is the other component of the basic financial reports. Recall that there are 3 different types of funds that we are looking at: the governmental, the proprietary, and fiduciary funds. Governmental funds will have to prepare balance sheet and a statement of revenues, expenditures, and changes in fund balance. Proprietary and fiduciary funds will have similar financial statements. It'll also prepare statement of net position, statement of revenues, expenses, changes in fund net position, and the statement of cash flows. Like I said, fiduciary funds will be preparing similar statement, but it doesn't need to prepare the statement of cash flows. In terms of the focus of fund financial statement, governmental funds focus on fiscal accountability, and it's looking at more the flow of current financial resources. So it's more the short-term view. And recall that instead of using accrual basis, governmental funds will use the modified accrual basis. And these days, cash accounting is not even recommended. All right. Proprietary funds focus on the operational accountability, the flow of economic resources, and it uses the accrual basis of accounting. Fiduciary funds, very similar to proprietary funds. It uses accrual basis and it's focusing on also operational accountability and the flow of economic resources. Now, we have to understand that because the governmental activities, as we have seen in the previous slide, uses accrual basis in government-wide financial statements, whilst on the other hand, the modified accrual basis is used in governmental funds financial statements. There will be differences in fund balances on reporting on operating results on fund financial statements compared to the government-wide financial statements. And because of the discrepancies in the modified accrual basis and the accrual basis, there is what we call the timing issue of when the elements are recognized. So there is a need to reconcile these balances. So it's pretty much like the preparation of bank reconciliation statements. So we know that the cash at bank account and the bank balance are not always the same because there might be outstanding checks, there might be deposits in transit and the like. So that's kind of similar with the governmental activities and the government-wide financial statements as opposed to fund balances. So reconciliation would be necessary. Fund reporting was developed to meet the challenges of reporting revenues and related expenditures that are legally or contractually constrained for specific purposes. So these funds that are constrained for a specific purpose need to be separately accounted for within the constraints, and that's why fund reporting is necessary. So we're now going into the last learning objective, and here we are going to discuss the nature of the major fund reporting and the criteria used to determine this as opposed to non-major funds. All right, but firstly, let's look at the fund concept. The concept of fund is fundamental to government accounting and reporting. Why is that? Because funds are considered as a separate fiscal entity. So it's a separate accounting entity. That means it has its own resources, its own liabilities, its own operating activity for the fiscal period, and it needs to be separately accounted for. Furthermore, a fund conceptually has its own set of records which allows it to prepare separate financial statements. So as a result, we'll need to learn how to account for these different funds. There are different fund categories: the governmental funds, the proprietary funds, and the fiduciary funds. So let's look at the governmental funds. The most common, of course, is the general fund. And general fund is definitely a major fund because that's where all the funds that are not assigned will be located or will be parked. Special revenue funds could be a fund that is set up, for example, a local government might have a library, and so the revenues from the library will be set aside for that particular service. Debt service funds will be set up if the government has bond or long-term liability obligations. And this fund will be solely for that purpose, for meeting the bond or long-term liability obligations. Capital projects funds could be set aside for things like if there are capital projects that will be needed in order for the government to accommodate an, for example, expected increase in population. So there might be a need to build roads, buildings, bridges, and the like. So they could set aside capital project funds. And permanent funds could be pertaining to specific endowments. So there might be someone or a foundation that has donated fund to the government, but for a very specific purpose. So that would be considered permanent fund. In terms of proprietary funds, the difference between enterprise funds and internal service funds is quite stark. When we're talking about enterprise funds, this has to do with the arm of the government that is business-like. So it could be utilities, it could be, for example, shipbuilding, and this government body is perhaps building ship for different governments or different countries or different entities. So they provide the service or the goods to the general public or to outside their organization. Whereas internal service funds are those government bodies that offers internal services to other government bodies, for example, purchasing their inventory or the materials that are needed, or it could even be the shipyard, the government shipyard that builds ships for the defense department. All right. Fiduciary funds, as what we have mentioned before, are custodial funds, or it may be pension trust funds. So it may be that the employees of the government have their pensions and they will be putting it into a trust fund. So accounting for that will fall under fiduciary funds accounting. All right. Now there are 5 fund classifications. So just go through this very briefly. The non-spendable fund balance, as the name suggests, are amounts that are in a form that cannot be spent, either according to law or contract, or it's just by nature unspendable. For example, the inventories, prepaid amounts, long-term notes receivable, they can't be spent. Other examples of an item that is legally or contractually required to remain intact and therefore not spendable is a permanent endowment, the one that I've mentioned before, where the donor specifically state for what purpose the donation is going to be spent. So it can't be spent on for any other purposes apart from the restriction. All right. Restricted. So permanent endowment can be either non-spendable or restricted in that sense, because restricted funds are amounts that can be spent only for the specific purposes designated by the external provider. The only way a restricted fund can be unrestricted or reassigned is when there is an enabling legislation. All right. So none of the government officials can actually use the restricted fund for another purpose. Only via the legislation can it be done. So that's restricted. What about committed funds? So committed funds are those that can only be used for a specific purpose as determined by the formal action. The action could be in the form of legislation or ordinance of the government's highest level of decision-making authority. So this highest level of decision-making authority could be the legislature, it could be the county commission, or it could be the city council. Now, committed funds can be used for another purpose by reversing the formal action that committed the resource. But the only one who can do that as well is that highest level decision-making authority. An assigned fund is one where the intended use of the fund is stipulated or is stated. Now, who makes that intention declared, or who declares that intention? Well, that intent or intention can be expressed in one of two ways. Number one, the governing body can state its intent to use the resources for a specific purpose, or number two, the governing body can delegate the authority to others. So for example, a budget or a finance committee or the manager of the city council will be given the authority to assign certain amount for a specific purpose. So as an example, we might decide as a committee to set aside $50,000 for improvement of the library. So we are assigning $50,000 for library improvement. Now, the next classification is unassigned. This is the amount remaining in the general fund balance after classifying amounts as either non-spendable, restricted, committed, or assigned. Now, if, for example, the assigned amount of $50,000 for improvement of library is no longer needed because we realize that, well, the library is churning in quite good revenues and therefore it can fund its own improvement, then we can make the decision to unassign that 50,000. So it's just a matter of reversing or making another decision to redistribute that assigned amount so it can go back to the general fund balance. The general fund is the only fund that will have a positive unassigned fund balance. So if any other fund has expenditures that exceed the amounts restricted or committed or assigned, it may be necessary for the fund to report a negative unassigned fund balance. Now, GASB does not like that. So that it doesn't allow negative, restricted, committed, or assigned fund balance. So it may be that the government highest decision-making authority will have to make a decision to transfer some from the general fund to any of those negative, committed or restricted or assigned fund balances. All right. Governments may have many different funds, but users are likely to be most interested in information about funds with bigger amounts, of course. So GASB requires separate columns for all the major funds, but the non-major funds may just be grouped together and reported in a single column. So in terms of non-major fund reporting, although GASB requires non-major funds to be reported in a single column, many governments report details regarding the non-major funds in supplementary combining financial statements as a part of the CAFR, the Comprehensive Annual Financial Report. Now, how do we determine whether a fund is considered major or non-major fund? This is the final topic, subtopic that we will discuss. Well, major funds will definitely include general funds. So general fund is most certainly a major fund, all right? What about the other funds? Well, if the other funds meet both of these criteria that we'll be looking at, then they are considered major fund as well. So what's the first criteria? First of the two criteria, total assets, total liabilities, revenues, or expenditures and expenses of that fund must be at least 10% of the corresponding element total for all funds of that category or type. So the 10% rule. The second one is the same element, so whether it's total assets, liabilities, revenues, or expenditures, expenses, must meet that 10% criterion is also at least 5% of the corresponding element total for all governmental and enterprise funds combined. Okay, so how do we apply this? Because the two criteria must be met for a fund to be considered a major fund. Remember that major fund must be reported separately in different columns, whereas non-major funds can be put together and shown into one single column. So it's important that we are able to identify correctly which are major fund and which are non-major fund. So here is an example from your textbook. To determine first whether a fund meets the 10% and the 5% criteria, we must first calculate the threshold amounts for each element for the total governmental funds and the total governments and enterprise funds. This is displayed in the two rightmost columns, the one that I'm highlighting now here, all right, in this table. So once we have the figures for the 10% criteria or criterion and the 5% criterion. So remember, the 10% criteria is for total governmental funds. The 5% criterion is for governmental and enterprise funds, the total of those two amounts. So the first thing we need to do is to calculate what's 10% of total government funds for assets and total government and enterprise funds for the same element, the assets, all right? So it's already given here in this example. So it's 4,492,627 is the 10%, and the 5% is 4,082,141. So we will be looking at three different funds: the road tax, debt service, and capital project funds. All right, let's start for assets only. Starting with assets, right? We can see that the road tax fund does not meet or exceed the 10% and also the 5%. So we need to satisfy both, all right? It can't be one or the other. For debt service, it's only 3,892,020. So it doesn't, again, meet the 4,492,000, 10% and the 5% as well. What about capital projects? Yes, it does. All right. So it's 19,273,676 is the total assets. And if we compare that with the 10% of total government funds, it definitely exceeded it by quite a lot. It's only 4,492,627. And for the 5% total of the governmental and enterprise funds, it's only 4,082,000, and we've got 19 million plus here. So most certainly, capital project funds is a major fund, okay, in terms of the assets. Let's have a look at the debt service. All right. In terms of, again, you can look at the assets. So assets, it doesn't meet the 10% and 5% criteria. Even the liabilities, no. But revenues, as you can see, exceeded the 10%. So 6,836,472. And the 10% is only 6,073,695. So it exceeded it. What about the 5% criteria? 5% is 3,942,318. So again, the revenues of debt service fund exceeded the 5% rule. So therefore, the debt service fund is also a major fund. Okay, so it needs to be separately accounted for as a separate column. What about road tax fund? If you actually have a look, all the elements, whether it is assets, whether it's liabilities, revenues, or expenditures and expenses, it does not exceed or equal the 10% or the 5% figure. So therefore, road tax is a non-major fund. All right, so I hope that is clear. I know it took quite a while, but we have reached the end of the first lecture. All right, I'd like to share with you before I end this recording, I'd like to share with you a cartoon that has been introduced to me. And it's kind of funny, but it's also got quite a lot of truth in it. It says, if you want happiness for an hour, take a nap. So some people find happiness in taking a nap, but I do hope that you haven't been taking a nap whilst this lecture is going on. Otherwise, are you happy now? And it also continues, it says, if you want happiness for a week, go on a vacation. Perhaps that is a good advice. And it says, if you want happiness for a year, inherit a wealth. Well, it would be nice if someone will give us wealth, isn't it? I thought this next one is actually quite profound and true. If you want happiness for a lifetime, learn to love what you do. Might remind you of the Bible verses that I've introduced at the beginning. So I would suggest too that if you want to be happy for the rest of the semester, learn to love ACCT 423. Now, in our subsequent meetings, whether it's in tutorial, I would like to, or in the remaining time of our lecture this week, I would like to hear your thoughts about these Bible verses. If you all didn't have time to give me your thoughts about these two Bible verses in Ecclesiastes 9 verse 10 and 1 Corinthians 10:31, I would like to hear about it in our tutorial discussion. Right, so this is it for topic 1 lecture, and I really look forward to meet all of you soon. All right, bye for now, and I will certainly see you soon.